Thanks for joining us today at the Mining News Network podcast. Let's get started.
Hey everyone, welcome back. Today we're going to be looking at Newmont Corporation and specifically their latest press release announcing the sale of their Eleonore gold mine.
Interesting.
So we'll be kind of dissecting that press release and figuring out what's going on there and how it plays into Newmont's larger strategy.
Yeah.
And hopefully as a listener you'll come away with this thinking,
Right.
this is what I should be watching for in terms of like Newmont share price and stuff like that.
Yeah, definitely. Because I think, this is a big shift for Newmont.
Definitely a big shift. Yeah.
We'll get into it.
Yeah, let's dive right in.
Okay.
The press release states that Newmont is selling Eleonore, which is located in Quebec, Canada, to Dhilmar Ltd.
Okay.
And the sale price is $795 million in cash.
Wow.
Yeah. Pretty hefty chunk of change.
It is.
And they expect the deal to close in the first quarter of 2025.
Okay.
So what jumps out at you right away when you just hear that at the top level?
Well, I think the most interesting thing is that Dhilmar Ltd is a newly formed private company.
Oh, interesting.
Yeah. This isn't some big player swallowing up another mine.
Right.
So it kind of raises the question of, who are these folks?
Yeah.
And why are they interested in Eleonore?
Yeah, and maybe why would Newmont sell it to this small company?
Exactly.
Yeah, okay, so that's a good point. So digging a little bit deeper into this press release,
Okay.
it mentions that the CEO of Dhilmar is Alexander Ramley.
Okay.
And it says that he and his team have experience with Newmont.
Oh, okay.
Going back to 2016, they acquired the Batu Hijau copper and gold mine in Indonesia from Newmont.
Okay.
And so I think that's a really critical point.
Absolutely.
Because under Ramley's leadership, Batu Hijau has been extremely successful. It now has a market cap exceeding $40 billion.
That's impressive.
So maybe this Dhilmar knows what they're doing.
Yeah, it sounds like they might have a knack for unlocking value in these mining assets.
Yeah, that's a great point.
Yeah.
So I guess the next question then is, why is Newmont selling this mine in the first place?
Right.
It seems like a pretty good mine to hold on to, right?
Yeah, it's a good question. So this is where we get into Newmont's strategy.
Yep.
They're actively trying to reshape their portfolio.
Okay.
They want to focus on what they call Tier 1 gold and copper assets.
Okay, so what are those?
So essentially, these are their highest performing mines.
Gotcha.
Mines with long lifespans, low operating costs, and the potential for, strong and sustainable profits.
Okay, so they're basically like their crown jewels, right?
Yeah, exactly. They're the cream of the crop.
The best of the best.
Yeah, and it's all part of this calculated strategy to streamline their operations.
Oh.
They want to prioritize the mines that are going to offer the greatest potential for long-term value creation.
Okay.
And that might mean, slightly reducing their overall production in the short term.
So it's like a quality over quantity approach.
Right.
Okay, that makes sense. And the press release actually mentions that Newmont's already exceeded their initial target
Okay.
from these divestitures. Their initial target was to generate $2 billion
Wow.
from selling off these non-core assets.
Right?
And they've actually brought in a total of $3.6 billion to date.
So they're well ahead of schedule.
Yeah. And it seems like they're not done yet.
Yeah, they're still going strong.
In addition to Eleonore, they've sold or are in the process of selling a number of other assets,
Okay.
including their Telfer operation,
Uh-huh.
a 70% interest in the Havieron project,
Okay.
their Akium operation, and their Musselwhite operation.
Wow, so they're really serious about this.
They're definitely committed to refining their portfolio.
Yeah.
And they've also been strategically divesting investments,
Okay.
including a stream credit facility with London Gold and contingent payments from Batu Hijau.
Okay.
So, yeah, it really paints a picture of a company that's actively reshaping itself.
It does, yeah.
So the next question then is, what are they going to do with all this cash?
Right.
Because it's a lot of money.
Yeah, they've got a lot of options.
Surely they have a plan.
So according to Newmont, they intend to use the proceeds to do two things.
Okay.
First, they want to strengthen their balance sheet, basically reduce their debt.
Okay.
And second, they want to return capital to shareholders.
Okay, so what does that mean exactly?
So that could mean a couple of things.
Yeah.
It could mean increasing their dividends,
Wow.
or it could mean buying back their own shares.
Okay.
And both of those actions could have a positive impact on their share price.
Okay, now we're getting to the heart of the matter.
Right?
How these moves might actually impact Newmont's share price.
Yeah, That's the million-dollar question.
What are your initial thoughts on that?
Well, in the short term, there's always the potential for some volatility.
Right.
When a company makes big strategic changes like this,
Yeah.
Investors might react positively or negatively depending on their individual outlook.
Right.
But I think it's important to consider the potential longer-term impacts.
Okay.
So,
Yeah.
for example, reducing debt can lead to a higher credit rating,
Okay.
which basically signals to investors that the company is more stable and reliable.
Gotcha.
And that can often translate into a higher share price.
Makes sense.
And then returning capital to shareholders can make the stock more attractive,
Yeah.
which can potentially drive up demand and therefore the price.
Okay, so you're seeing mostly potential upsides here.
Well, there are always risks to consider as well.
Okay, yeah. What are some of the potential downsides?
Well, one thing to think about is that selling off assets could reduce Newmont's production capacity,
Right.
at least in the near term,
Uh-huh.
and that could potentially hurt their revenue.
Yeah, that's a good point.
So it's a calculated risk, right?
Mm-hmm.
They're betting that the long-term benefits of focusing on their most profitable mines and strengthening their financial position will outweigh any short-term dips in production.
Okay, yeah.
It's like a trade-off.
It is, yeah. And I guess the market's reaction to all these moves
Right.
will depend on whether investors believe that Newmont's making the right bets for the future.
Exactly. It's all about perception.
Yeah. And we've covered a lot of ground already,
We have.
but there's still a lot more to unpack.
Oh, yeah.
Like the potential impact on Newmont's dividend policy
Mm-hmm.
and what this all means for the broader mining industry.
Right. So we were talking about how reducing debt can lead to a higher credit rating for Newmont.
Right. And you were explaining how that's a good thing for investors.
Exactly.
Can you break that down a little bit more? Like, why does a higher credit rating matter so much?
Sure. So basically, a credit rating is like a measure of how likely a company is to repay its debts. Kind of like a report card for their financial health.
Okay.
And the higher the credit rating, the lower the risk for those who invest in their debt.
So a higher rating means less risk for investors,
Exactly.
which makes Newmont a safer bet.
Right. And that perception of reduced risk can actually translate into a higher share price.
Interesting. How so?
Well, investors are often willing to pay a premium for companies that are perceived as financially stable
Makes sense.
and reliable.
Okay, that makes sense. And then you also mentioned returning capital to shareholders.
Yes.
How does that work?
So there are a couple of ways Newmont can do this.
Okay.
One is through dividends,
Uh-huh.
which are basically regular payments made to shareholders from the company's profits.
Okay.
And the other is through share buybacks,
Okay.
where the company uses its own cash to buy back its own shares from the open market.
Okay, so how do those things actually boost the share price?
Well, with dividends, investors see a direct return on their investment. A higher dividend yield can make a stock more attractive to income-seeking investors,
Okay.
leading to increased demand and potentially a higher share price.
So it's like getting a little bonus for owning the stock. And what about share buybacks?
The share buybacks are a bit more nuanced.
Okay.
When a company buys back its own shares, it reduces the number of outstanding shares in the market,
Uh-huh.
and this can increase earnings per share,
Yeah.
which is a key metric investors use to value a company.
So even if the overall earnings stay the same, the earnings per share go up because there are fewer shares to divide them among.
Precisely.
Interesting.
And when earnings per share go up,
Uh-huh.
it can signal to investors that the company is becoming more profitable,
Gotcha.
which can push the share price upward.
Okay, so it seems like Newmont's moves to reduce debt and return capital to shareholders
Right.
are generally positive for the share price.
Yeah, in theory, they should be.
But you did also mention some potential downsides.
Yes, of course, there are always risks.
What should investors be cautious about?
Well, one thing to keep in mind is that it might take some time for the market to fully react to these changes.
Okay, so patience is key.
Exactly. Stock prices don't always react instantly.
Right.
Sometimes these things take time to play out.
And what about the risk of those divested assets
Yeah,
outperforming expectations under new ownership?
that's a valid concern.
Yeah.
If those mines that Newmont sold off suddenly become booming successes,
Right.
some investors might start to second-guess their strategy.
Yeah, that's a good point.
Yeah.
So it sounds like Newmont's taking a calculated risk here,
They are.
betting on their ability to choose the right assets to keep
Mm-hmm.
and the right ones to let go,
Exactly. It's all about making strategic choices.
and trusting their expertise.
And this is where their deep experience in the mining industry becomes crucial.
Yeah, they definitely have a lot of experience.
They have a long track record and a deep understanding of this market.
So it's kind of like they're saying, we know what we're good at, and we're doubling down on our strengths.
Exactly. They're focusing their resources and expertise where they believe they can generate the most value.
Okay, that makes sense. Now let's shift gears a little bit.
Okay.
And talk about the potential impact on Newmont's dividend policy.
Right.
They've been consistently paying dividends.
They have.
And even increasing them recently.
Yes.
Do you see that continuing?
Well, dividends are definitely a key part of Newmont's capital allocation strategy.
Okay.
They have a solid history of paying dividends.
Right.
And they've signaled their intention to maintain a strong dividend going forward.
Okay.
However, it's important to remember that any significant strategic shift like this can potentially lead to changes in dividend policy.
So investors should basically stay tuned and see what happens.
Yes, it's always wise to stay updated on any changes or updates to a company's dividend policy.
Right.
While Newmont aims to maintain a strong dividend, the specifics could shift based on market conditions and their financial performance.
Okay, so a lot of factors at play here.
There are, yeah.
It seems like Newmont's making some bold moves.
They are.
And it's still too early to say definitively how it will all shake out.
It is, yeah.
But understanding the potential upsides and downsides is crucial for investors.
Absolutely. It's all about weighing the risks and rewards.
This has been incredibly insightful.
Glad to hear it.
But we haven't yet touched upon the broader implications for the mining industry as a whole.
Right. That's an important point.
What trends are we seeing out there?
Well, I think it's important to recognize that Newmont's strategic shift isn't happening in a vacuum.
Okay.
It's part of a larger trend in the mining industry
Okay, like what?
towards consolidation and a focus on high-quality assets.
Interesting. So what's driving that trend?
Well, several factors are at play.
Okay.
One is the increasing complexity of mining operations
Okay.
as ore grades decline and mines become deeper and more remote. The costs of exploration and extraction are rising.
Okay, that makes sense.
This makes it much harder for smaller companies to compete.
So it's becoming a game for the giants.
In a sense, yes.
Right.
Larger companies have the resources and expertise to tackle these more challenging projects.
Right.
And they also have the financial muscle to invest in new technologies and innovations that can improve efficiency and reduce costs.
So they have a competitive advantage there.
Exactly.
And what about the focus on high-quality assets?
Right. So that ties directly into the rising costs
Okay.
and the need for efficiency in a more challenging market environment.
Yeah.
Companies are realizing that it's not just about producing more. It's about producing more profitably.
So it's a shift from quantity to quality.
Exactly.
Okay.
Companies are becoming more selective about the projects they invest in.
Right.
They're seeking mines with higher ore grades,
Okay.
longer lifespans, and lower operating costs. These are the Tier 1 assets that Newmont is concentrating on. They want the best of the best.
Makes sense. So do you think this trend toward consolidation and a focus on quality is likely to continue?
I do. I think the mining industry is constantly evolving.
Right.
And the companies that can adapt to these changing dynamics are the ones that will thrive in the long run.
Okay. Yeah, that makes sense. Well, we've covered a lot of ground today.
We have.
From the specifics of Newmont's divestitures to the broader trends shaping the mining industry. But before we wrap up, I'm curious to hear your thoughts on what all of this means for the future of gold and copper.
That's a great question.
Yeah.
It's always tough to predict the future.
It is, yeah.
But I think Newmont's actions suggest they're anticipating continued demand for both gold and copper,
Okay.
but within a landscape that's likely to become more competitive.
So are they basically battening down the hatches, preparing for a potential storm?
You could say that by streamlining their operations and focusing on their most profitable mines.
Oh, yeah.
They're aiming to be more resilient.
Okay.
They want to be able to thrive even if metal prices fluctuate or costs continue to rise.
So they're not just banking on one particular outcome.
Exactly.
They're preparing for a range of possibilities.
Right. It's all about adaptability.
So what's the key takeaway here for investors?
I think the key takeaway is that Newmont's moves are a microcosm of the larger forces at play in the mining industry.
Right.
We're seeing a shift towards consolidation, a focus on quality assets,
Right.
and a need for greater efficiency and adaptability.
Okay.
These trends are likely to continue shaping the industry for years to come.
So Newmont's journey is a case study in how companies in this sector are adapting to a changing world.
Absolutely.
And it underscores the importance for investors to really stay informed about the companies and industries they invest in.
Couldn't agree more.
This has been a really enlightening deep dive.
Glad to hear it.
Thank you so much for sharing your expertise with us.
It's been my pleasure.
So we've been talking about Newmont and all these moves they're making, selling off mines, focusing on their top performers. And you've been explaining how this all fits into the bigger picture of the mining industry.
Yeah.
But I keep coming back to this question of what does it all mean for the future of gold and copper?
It's the big question, right?
Yeah, like where are those markets headed?
Well, I think Newmont's actions suggest they're betting on continued demand.
Okay.
For both gold and copper.
Okay, so they're not abandoning those metals?
No, not at all.
But you mentioned earlier that the landscape is likely to become more competitive.
Right.
So are they getting ready to weather a potential storm?
Yeah, you could say that.
Okay.
By streamlining their operations and focusing on their most profitable mines, they're aiming to be more resilient. They want to be able to thrive even if metal prices fluctuate or costs continue to rise.
So they're not banking on one particular outcome for those markets.
Right.
They're preparing for a range of possibilities.
Exactly. It's about adaptability.
Yeah, and that makes a lot of sense. So for our listeners out there, what's the key takeaway from all this?
I'd say Newmont's journey offers a really valuable lesson.
Okay.
Look for companies that are making strategic choices for the long haul. Companies that aren't just chasing quick wins.
Right, they're thinking long-term.
Exactly. They're focused on long-term value creation.
And that's important no matter what industry you're looking at.
Absolutely.
Any other final thoughts before we wrap things up?
I think it's just crucial to remember that Newmont's actions are part of a bigger trend.
Okay.
A shift happening across the mining industry.
Right, towards consolidation and a focus on quality.
Exactly. And a need for greater efficiency and adaptability.
Yeah.
These trends are likely to shape the industry for years to come.
So Newmont's story gives us a window into the future of mining.
Yeah, I think so.
It highlights the challenges and opportunities that lie ahead.
For sure.
Well, this deep dive into Newmont's strategic shift has been incredibly insightful.
Happy to hear that.
Thank you so much for joining us and sharing your expertise.
It's been my pleasure.
And to all our listeners out there, thanks for tuning in.
Yeah, thanks for listening.
We'll see you next time for another deep dive.
Thank you for listening to the Mining News Network. If you found this content helpful, please don't forget to drop us a like and subscribe. If there are topics or companies that you would be interested in or like us to cover next, please leave a comment down below.